In 1999, a 34-year-old software engineer named Michael sat down with a life insurance agent who spent 2 hours explaining why whole life insurance was the smartest financial product he could buy. Tax-advantaged growth, guaranteed cash value, lifelong coverage, a death benefit his family would never lose, an investment and insurance in one product. Michael bought a $500,000 whole life policy with a monthly premium of $387. 23 years later, Michael reviewed his policy at 57. His cash value, the investment component he had been told would grow tax-advantaged, was $89,000. His total premium payments over 23 years were $106,884. He had paid $106,884 and accumulated $89,000 in accessible value. He had lost $17,884 in absolute terms, before accounting for what that same $387 monthly invested in an S&P 500 index fund would have produced instead. That number was $412,000. Michael did not make an uninformed decision. He was presented with accurate information about his policy, selectively. What he was never shown was the comparison. The alternative, the opportunity cost of $387 monthly compounding in the market versus compounding inside a product whose internal costs consumed a significant portion of every premium he paid. According to LIMRA, the insurance industry's own research organization, approximately 60% of life insurance sold in America is permanent life insurance, whole life, universal life, or variable life, products that combine insurance coverage with an investment component. Products that generate significantly higher commissions for the agents who sell them and significantly worse financial outcomes for most of the families who buy them. This video documents exactly how the life insurance trap works, who it benefits most, what it actually costs families over time, and the simple alternative that provides equivalent protection for a fraction of the price.
Data from LIMRA Insurance Industry Research, the Consumer Federation of America Life Insurance Disclosures, the National Association of Insurance Commissioners, the Securities and Exchange Commission Variable Life Insurance Disclosures, the Journal of Financial Planning Permanent versus Term Insurance Analysis, and the Federal Reserve Survey of Consumer Finances 2023. Industry research bodies, regulatory agencies, and academic financial planning research, not opinions. To understand the trap, you need to understand that life insurance is not one product. It is two fundamentally different products sold under the same name. Term life insurance is pure insurance. You pay a premium. If you die during the coverage period, your beneficiaries receive the death benefit. If you do not die during the coverage period, the policy expires and you receive nothing back. That is the entire product. A 40-year-old male in good health can purchase a $500,000 20-year term policy for approximately $25 to $35 monthly in 2026, according to Policy Genius rate data. The product is straightforward, transparent, and inexpensive.
Permanent life insurance, whole life, universal life, indexed universal life, variable universal life, combines a death benefit with an investment component called cash value. Part of your premium pays for the insurance coverage. Part goes into the cash value account that grows at a rate determined by the policy type. The coverage never expires as long as premiums are paid. The cash value is accessible through loans or withdrawals during your lifetime. This sounds superior to term. It is designed to sound superior to term. The industry calls term insurance renting versus owning when comparing it to whole life, a framing specifically engineered to make the cheaper, simpler, more appropriate product feel inadequate. The Consumer Federation of America's analysis found that the internal rate of return on whole life insurance cash value, what the investment component actually earns after the insurance company's costs, agent commissions, and administrative fees are extracted, averages approximately 1 to 2% annually in the early years of the policy, and reaches approximately 3 to 4% only after many decades of consistent premium payment. Against an S&P 500 index fund returning an average of 10% annually over the same period, the comparison is not close. But that comparison is never made in the agent's office. The agent's incentive structure specifically discourages it. The reason permanent life insurance is sold so aggressively is not that it is the best product for most families. It is that it pays agents significantly more than term insurance does.
A life insurance agent who sells a $500,000 whole life policy with a $387 monthly premium earns a first-year commission of approximately 50% to 110% of the annual premium. On $387 monthly, $4,644 annually, the agent earns approximately $2,300 to $5,100 in first-year commission alone. Renewal commissions of 3% to 5% of the annual premium follow for subsequent years. A life insurance agent who sells a $500,000 20-year term policy at $30 monthly earns a first-year commission of approximately 40% to 70% of the annual premium. On $360 annually, approximately $144 to $252. The same client, the same $500,000 death benefit need, 20 times higher commission for the agent who recommends whole life over term.
This commission differential does not mean every agent recommending whole life is acting in bad faith. Some believe in the product they sell, but the incentive structure creates a systematic bias toward recommending the higher commission product regardless of client suitability, a conflict of interest that is legal, disclosed in fine print, and rarely explained directly to the client making the purchase decision. The National Association of Insurance Commissioners has documented that surrender charges, penalties for canceling a permanent life insurance policy before a specified period, frequently run 7% to 10% of cash value in the early years of the policy, declining over 10 to 15 years. A family that purchases a whole life policy and then discovers the product is unsuitable and attempts to cancel it in years 2 through 7 frequently loses a significant portion of the cash value they have accumulated to these surrender charges. The product is designed to be difficult to exit, not through deception, but through a cost structure that makes persistence the only rational choice once the decision is made.
Michael's story from The Hook represents the calculable cost of the life insurance trap with reasonable accuracy. But the opportunity cost math deserves more detailed examination because it is the number the industry never wants consumers to run. The term versus invest the difference calculation is the framework that insurance industry critics have used for decades, and that the industry has spent decades dismissing as oversimplified. It is not oversimplified. It is the most honest comparison available. A 34-year-old purchases a $500,000 whole life policy at $387 monthly. A 34-year-old purchases a $500,000 30-year term policy at approximately $35 monthly and invests the $352 difference in an S&P 500 index fund. After 30 years, at the standard 7% real return assumption used by financial planners, the Term Plus Invest approach produces approximately $1.07 million in accumulated investment value. The whole life policy produces cash value of approximately $150,000 to $200,000, depending on the specific policy and dividend performance.
The gap, approximately $870,000 to $920,000, is the measurable cost of the permanent insurance trap over a 30-year holding period. Not hypothetical, not cherry-picked, the mathematical result of compound interest applied equally to both options. At 64, the term policy expires and the investment portfolio stands at approximately $1.07 million. At 64, the whole life policyholder has a death benefit that still exists and cash value of approximately $150,000 to $200,000. If they no longer need life insurance at 64, which most financial planners say is true for most people whose children are grown and whose retirement assets are established, they have paid for a product they no longer need while foregoing nearly $900,000 in investment returns. The Journal of Financial Planning's research on permanent versus term insurance confirms that for the majority of American families, the Term Plus Invest approach produces superior financial outcomes, and that the exceptions are narrow, specific circumstances where permanent insurance provides genuine advantages that term cannot replicate. This video is not an argument that permanent life insurance is always wrong. It is an argument that it is wrong for most people who buy it, and that the commission structure ensures it is sold to people it is wrong for far more often than it should be. The genuine use cases for permanent life insurance are specific and narrow. High net worth estate planning, specifically irrevocable life insurance trusts used to provide liquidity for estate tax obligations, represents a legitimate application where the tax-advantaged death benefit of permanent insurance serves a function that term cannot replicate. This applies to estates above the federal estate tax exemption, currently $13.61 million per individual, a threshold relevant to a small fraction of American families.
Business succession planning, buy-sell agreements funded by permanent insurance that ensures business partners can purchase a deceased partner's ownership stake, represents another legitimate specialized application. Individuals who are uninsurable for term insurance due to health conditions may find that converting an existing term policy to permanent coverage or purchasing permanent coverage is the only available option for providing any death benefit to their family. For the vast majority of American families, those with dependents who need income replacement, those building toward retirement, those managing mortgages and education costs, term life insurance, purchased in an amount that covers actual financial obligations, combined with consistent investment in tax-advantaged accounts, produces superior financial outcomes to permanent insurance in virtually every documented analysis. The framework that actually serves most American families is straightforward enough to explain in 4 steps. Step 1. Calculate your actual insurance need honestly. The standard recommendation is 10 to 12 times your annual income in death benefit, enough to replace your earning capacity for a decade while your family adjusts financially. A breadwinner earning $75,000 needs approximately $750,000 to $900,000 in coverage. A dual-income household needs to calculate each partner's replacement value separately. Step 2. Purchase term life insurance for the period your dependents actually need protection. If your youngest child is 3 and you plan to retire at 65, a 30-year term policy covers the entire period during which your death would create genuine financial hardship for your family. After 65, with retirement assets established and children financially independent, most families no longer need life insurance at all. Term expires at exactly the right moment. Step 3. Invest the difference between what you are paying for term and what you would have paid for whole life, immediately and automatically. The entire value of the buy term, invest the difference strategy depends on the investment actually happening. The $352 monthly difference between a whole life and a term premium must go directly into a retirement account or index fund, not into a vacation, not into a lifestyle upgrade, into the market. Automate this transfer on the same day your term premium is paid. Step 4. If you currently own a whole life policy, review it with a fee-only financial advisor who has no commission incentive, specifically a certified financial planner operating under a fiduciary standard. The decision to surrender an existing whole life policy or continue it depends on how many years of premiums have already been paid, the current surrender charge schedule, the internal rate of return at your specific policy's current stage, and your current tax situation. The answer is not automatically to cancel. It requires analysis by someone whose compensation does not depend on your decision. The National Association of Personal Financial Advisors maintains a directory of fee-only fiduciary advisors at napfa.org, advisors who legally cannot receive commissions from product sales and whose only compensation is a fee paid directly by you. Michael is 57. His whole life policy has $89,000 in cash value after $106,884 in premiums. His index fund, if he had invested $387 monthly for 23 years at 7% real returns, would have approximately $412,000 today. The $323,000 gap between those two numbers is not a fraud. Michael was not deceived about his policy's terms. He was presented with accurate information about what his policy would do, and never shown the comparison that would have clarified what it would cost him to choose it over the alternative. The agent who sold Michael his policy earned approximately $3,000 in first-year commission. The agent who would have sold Michael a $35 monthly term policy would have earned approximately $180. That $2,820 commission difference, applied across millions of policies sold annually, explains why the industry sells 60% permanent insurance to a population for whom 90% of financial planners say term is more appropriate. The life insurance trap is not complicated once you understand it. One product serves the financial needs of most families efficiently and inexpensively. The other serves the commission needs of the distribution system that sells it. Knowing which is which before you sit across from an agent is worth approximately $323,000 over 23 years. Now you know.
Tell me in the comments, do you currently own whole life or permanent life insurance? Just yes or no, no judgment. The industry data says 60% of life insurance sold in America is permanent. That means a significant share of people watching this video right now are paying a premium they may not need to pay. This channel documents the financial products, systems, and structures that extract from American families and the specific alternatives that serve them better. No product recommendations, no commissions, just the documented math. If that is worth something to you, subscribe.